Hello, I know that some of you guys are preparing for the May-June exams. I'll try to give a detailed explanation of how we go about these adjustments. This is a very good question. It's extracted from the November 2022 CAPS curriculum. It's a really good paper for what I want to talk about. These adjustments are very detailed. They'll help you understand how the plus and the minus come about on the income statement, as well as the entries that you make on your balance sheet. Before you start looking at the questions, please note the financial year. The financial year is simply when the business year starts, the accounting year starts. A business or a company, in this case, will pick a financial year, much like any other year. It's 12 months. And if it ends in February, it would have started in March the previous year. So for this question, the financial year ends 28 Feb 2022, meaning that it started in March 2021. Okay? So for the first question, we are required to calculate the cost of the stock that was damaged. And we are told that we'll find this information if we go to information B. So there we have it. If we look at the information that we have, we started off with an opening balance of 1,900 sports t-shirts. And we had purchased all these 1,900 t-shirts at 660 per shirt. And the total of that was 1,254,000. We made further purchases of 7,100 units. But this time around, the manufacturer or the supplier charged us 750 per shirt, which amounted to a total cost of 5,325,000 rands. Right. We are then told that at the end of the current financial year, remember our current financial year is March 2021 to Feb 2022. So at the end of the current financial year, we are left with 1,185 units. We want to know what is the value of those shares. So what we do is we work out the average cost per share so that we can value this 1,185 shares. And the weighted average tells us that the price per share is 731. Now that we've worked out the weighted average price, we can answer the question. The total units that we had that was available for sale is 9,000, but we also provided with the actual that we've sold, the 7,750. If we want to find out the number of units that we have in storage, we just take the 9,000, which is the total units that we had, and subtract the total units that we have sold. We can see that we are supposed to end up with 1,250 shares in storage. We were told that the actual stock balance that we have is this 1,185. So we work out the difference between the 1,250 and the 1,185. And that will give us the number of stock that was damaged. So there you have it. Next, we work out the value of this damage. We have 65 units that were damaged, and we know that a value of 1 unit is 731. 65 units multiplied by the weighted average price. There you have it. And we are told that we need to write off this as a loss, right? We know that on our statement of comprehensive income, that's where we record our incomes and expenses. So this loss will be recorded there. I hope that was very clear. Let us move to the next question to work out if we made a profit or loss on our asset disposal. Number 2, we need to work out the total depreciation for the year. From the information that we supplied with, we can see we're provided with some values and some values are missing. We'll need to read the additional information to see what we can do. Our vehicles are depreciated at 20% per annum on diminishing balance method. Remember, diminishing balance method means that you depreciate the carrying value. So you need to first work out the carrying value and then multiply it by the depreciating percentage. Carrying value is cost minus accumulated depreciation. Before we get started, let us first understand what accumulated depreciation is. assets lose value. If you purchase a car, it's going to lose value due to wear and tear, right? Depreciation is the value of that loss. And accumulated depreciation, you can think of it where we pack previous depreciations. So it's a record of all the previous depreciations that we have calculated in previous financial years up to date, okay? So this means that if we want to work out if we made a profit or a loss on our asset, we have to compare the selling price, the price that we've sold this asset for, and the carrying value. Why the carrying value? Because the carrying value takes the original purchase price, the cost price, and it subtracts all the previous loss of value, which is the accumulated depreciation. So the carrying value is the book value of that asset. So when we're looking for profit or loss, we compare the carrying value and the selling price. Sold, we are told that an old delivery vehicle with a carrying value of 170,000 on the 1st of March, remember, financial year starts 1st of March, ends Feb 2022. It was sold for 140,000 when? On the 1st of December 2021. We have to be a bit careful here. I said if we want to work out whether we made a profit or a loss, we compare the selling value and the selling price. The carrying value that I'm referring to is at the point of sale, at the day that we are selling the asset, not at the beginning of the year. If we look here, the carrying value that we have is at the beginning of the year. So we have to update that carrying value to reflect the carrying value at the point of sale, which is the 1st of December. From the start of the financial year on the 1st of March 2021, all the way to December, but we don't count December because we sold it on the 1st. So we didn't use it in the business for the whole of December. On the 1st, it was gone. We've only used it up until the 30th of November. We count from 1st of March to end of November. That will give us a total of 9 months usage. The total depreciation for the 9 months that we've used this vehicle before we sold it is 25,500. All right. Now that we've worked out the depreciation for the year, we need to go back and update the carrying value of this asset because we said that the carrying value is the book value of the asset. So if we're saying that no, for this year, the loss of value of this vehicle was 25,500, then it wouldn't be true to say that the value of this asset is 170,000. We need to go and subtract it from the 170,000 to get the actual book value for the financial year at the point of sale. The book value of this old delivery vehicle at the point of sale is 144,500. Now we can compare with the selling price. We have the updated book value and we have the selling price of 140,000 rand. As you can see, we made a loss because the book value, the value as per our financial record says that this asset is worth 144,500. But this person that we sold it to only got to buy it for 140,000. So we made a loss of 4,500. And that loss is going to be reflected in the statement of comprehensive income because that is where we show incomes and expenses. The next question required us to calculate the depreciation, if I'm not mistaken. Yes, the total depreciation for the year. This is for all assets. When you're trying to work out the depreciation for the year, I encourage you to make use of this table. So you'll segment it into 3 parts. The first one, you have new. This is depreciation for any new assets that we've purchased during the year. You have sold, depreciation for any assets that we've disposed, and old. So old are the assets that have always been in the business. We've already worked out the sold for that asset we disposed. On our information booklet, we are told that the bookkeeper had calculated the total depreciation as 328,200. So they've done a lot of the work for us. All we need to do is to adjust for the information that they have not adjusted for. The first one being this 25,500 from the old delivery truck. Next, we have an alarm system costing $48,000 was installed on the 1st of August 2021. Remember that when we are looking at depreciation, we are looking at the value of wear and tear. We are calculating the loss of value of this asset. So we need to calculate the loss of value of the alarm system from the time that we started using it, which is the 1st of August when we purchased it, to the end of the financial year, Feb 2022. How many months do we have for the period? A total of 7 months. The depreciation works out to be $4,200. And our total depreciation now will be what the bookkeeper has calculated, the $328,200, plus what we've calculated to be the depreciation for the disposed, as well as the depreciation for the new alarm system. Just in case you wanted to see how you were asked to format your answers on your answer booklet, this is the table that you were required to fill: depreciation for the sold and depreciation for the alarm system. This will give you a total depreciation of $357,900, including the one that the bookkeeper had already calculated. So we've worked out the total depreciation as per the question requested. Now let us see what we are required to do next. Prepare the statement of comprehensive income. Just to remind you what we're trying to do on the statement of comprehensive income, we are trying to reflect income that we have earned in the financial year and expenses that we have incurred in the financial year. So what this means is that if we have an adjustment that extends way outside of our financial year, we are going to subtract this portion from the part that was recorded. If we earned income for the whole year, but we were only paid for this period, on the statement of comprehensive income, we're also going to include this part. The next adjustment we have reads as follows. $33,700 received from a debtor whose account was previously written off as irrecoverable. In error to the debtor's control account, this must be corrected. When we receive payment from a debtor that was previously written off, this transaction does not affect debtor's control in any way. This person is no longer our debtor. So what we do is we create an income account to record money that we receive from such people, and that account is bad debts recovered. So if you have someone who was previously written off and they pay us, that goes into bad debts recovered, and that is an income, because we're not going to say, oh no, don't pay us, it's fine, we wrote you off. We're not going to do that. Number 2, the bookkeeper made a mistake. They subtracted the debtor's control balance, acting as if someone who was an actual debtor had paid their debt. What they've done is reduce the debtor's control balance. What this means is that the debtor's control that you're seeing here on the pre-adjustment trial balance, this debtor's control that you're seeing here we go, debtor's control. What we need to do is add it back to the debtor's control so that we can cancel out the effect of the bookkeeper's mistake and restore the balance to what it was before she made this mistake. What we've done here is we've corrected the debtor's control balance. We're told that the provision for bad debts must be adjusted to 3% of the debtor's control balance, 3% of this $2,780,000. Our provision for bad debts for the year, the end of the current financial year, Feb 2022, is $83,400. What this means is that at the end of the current financial year, we expect $83,400 worth of debtors to not pay us back. These are not bad debts. It's a safe basket that we put away for debtors that we think are going to go bad. Okay? If we look at the balances that we have, the balance for provision for bad debts at the beginning of the year, that is at the start of the current financial year, was $85,840. We need to adjust this provision from $85,840 to $83,400, and because we ended up with a lower provision for bad debts than what we started off with, meaning that we have adjusted it down, we expect less to go bad now, our provision for bad debts adjustment becomes an income. Remember, on the income statement, you only show provision for bad debts adjustment. It can either be an income or an expense. It's an income if what you end up with, the provision for bad debts that you end up with at the end of the financial year, is less than the one that you started off with at the beginning of the financial year. If you look here, there you have it. Our bad debts recovered, 33,700. Provision for bad debts adjustment. The adjusting amount, the one that is the difference between the provision for bad debts that we started off with and the one we ended up with, is the one that goes to the statement of comprehensive income. So if you look here, there's the 83,400 we calculated. This is what we ended up with at the end of the financial year. But when we started the year, we expected more debtors to not pay us. So that difference is a good thing, and that good thing is an income. The next adjustment reads as follows. The business signed a contract with Always Safe Securities for guarding the premises. An annual premium of 32,400 for the period ended 31 July 2022 was paid in full on the 1st of August 2021. This premium was paid somewhere during our financial year, so this would be August 2021. Since it's an annual, it's a year contract, it has its own 12 months. That 12 months starts on the 1st of August and it's going to end on the 31st of July. So if we draw a timeline for the securities expenses, we have something like this. Because this annual premium was paid during the financial year, it means that it's also included in the securities expense on our list of balances. If you go here, you'll see we have securities expenses for 72,500. We only want to reflect what falls in our financial year. So we want to keep this portion. It's in our financial year, and we want to get rid of this portion from that 72,500. So if this thing is an annual premium, it means that I can find the expense on a month-to-month basis. I just need to say 32,400 divided by 12. And if you do that, you'll find that the monthly premium is 2,700. If we were paying on a month-to-month basis, we would pay 2,700 August, 2,700 September, 2,700 October, and so forth, all the way to July, right? So now I can just count the months that don't belong in my financial year and get rid of them from my income statement. This would be from March 2022, right? So we are looking at this period that we want to get rid of. This would be from March 2022 because our financial year ends February 2022 all the way to July 2022. And that works out to be a total of 5 months. So if you work out what is the value of the 5 months, you'll say 5 multiplied by 2,700 and you will get 13,500. 13,500 does not fall in our financial year. We need to take it out. This is prepaid expenses. We have paid for services that we have not yet consumed. And this is an asset. It goes under trade and other receivables on the balance sheet. But on our income statement, we only want to reflect what falls in our financial year. Anything that falls out, we chuck it out. So securities expenses, 72,500 minus 13,500. And here's the loss on asset disposal that we worked out in question 1, 4,500. And the total depreciation expense that we also worked out. There you have it. All details in respect of February 2022 salary of an incorrectly debited to the sundry expenses. The following information relates to his salary. The business contributes 2 rands for every 1 rand deducted for the pension fund. So the first thing we need to do is to get rid of this amount from the sundry expense account. It does not belong there. The salary that we're looking for is the gross salary because that is what the business pays the employee. The net salary is what hits the employee's bank account. And this is because there are other interested parties that are going to take what is their portion. SARS is going to take income tax from this employee, and pension fund is also going to take their portion, sometimes medical aid as well as UIF. So what this means is that we paid this employee the gross salary. That is the expense that we have incurred in the business. We know that the gross salary, when you take out all the deductions, you're going to get the net salary. So here we're given the net salary, so we can work our way up to find the gross salary by adding back these deductions that were removed from the gross to get the net. This is how they would have arrived at the net salary. They would have taken the gross salary here, whatever it is, subtracted the SARS pay as you earn, subtracted the pension fund contribution. So we can work our way up to find what the gross was. If you take the net salary of 11,525, you add back the pension fund 990, you add back the SARS pay as you earn 3,235, you will arrive at a gross salary of 15,750. The business contributes 2 rands for every 1 rand deducted for pension fund. What this means is that the 990, remember this is the employee's contribution to his own pension fund. He earns 15,750. He takes 990 of that salary to pay for his pension fund. Employer contributes 2 rands for every 1 rand that the employee contributes. This means that if employee contributes 1 rand to pension fund, employer will contribute 2 rand. If employee contributes 100 rand towards pension fund, employer will contribute 200 rands. If employee contributes 990 to pension fund, employer will contribute 1,980 to pension fund. There are 2 expenses for the company. 1, the gross salary that they pay this employee, and number 2, the contributions that they make in addition to paying this employee their salary. So we need to add both the gross salary as well as the contribution to the expense account. If we have a look at our expenses, there you have it. Salaries and wages. A lot of the time contributions are going to be expensed to the salaries and wages account. Unless stated otherwise, make that assumption. This is the salaries and wages from the list of balances. Next, we have the employee's gross salary. And last, we have the 1,980 that the employer will contribute on behalf of the employee for their pension fund. Also, here is the stock loss that we've calculated in question 1. We've expensed it. A tenant has been leasing the office space, the premise, since March 2020. She has paid rent until April 2022. Note that the monthly amount was reduced by 1,350 as of the 1st of January 2022. Right. If we draw a timeline, that our financial year starts March 2021, ends February 2022. And we are told that the tenant paid until 30 April 2022. Started off with this tenant at the beginning of the financial year. How do you know that? Because this tenant has been with us since March 2020. The previous financial year, they don't matter. This is just information to let us know that we've started off the financial year with this tenant. As you can see from the timeline alone, before we work out any values, we can already see that we don't want this portion. This portion must be chucked out of the rent income. So let's look at the information that we're given so that we can work out the value that is supposed to be removed from the rent income. We're not given any monthly income, but we are given that the reduction was 1,350 from January. So if we have a look at the total number of months that we received rent for, it's 14. If you count all the way from March 2021 to April 2022, it's a total of 14 months. We only want March to Feb, a full 12 months. So this means that March 2022 and April 2022 are income received in advance. But we also told that the rent was decreased in Jan. So Jan would be somewhere here on the 1st of Jan. Now, we need to work out the total number of months we were receiving rent before the decrease and the total number of months that we received rent after the decrease. Then it means that for Jan, Feb, March, April, 4 months, we were receiving reduced amount. So we put in 4 months here. This would mean the remaining 10 months, so from March to December, receiving the rent before it was reduced. Okay. If we go to our list of balances, if we hop over here, we can see that we have rent income 183,600. This rent income is for 14 months. It's 14 months. And in those 14 months, the rent was not the same. If the rent was the same, we would just divide by 14. But it was not the same. There are some months that was before the reduction and other after the reduction. Let's set the original rent, the monthly rent, X. If the initial rent was X, then the reduced rent is X minus 1,350. Think about it. X is the amount that we were receiving on a month-to-month basis. And if on the 1st of January 2022, the rent was reduced by 1,350, then the new rent is X minus 1,350. We know that we received X for 10 months. So these are the months that we were receiving the original rent, and we received the reduced rent for 4 months. 10x, this is X received 10 times plus X minus 1,350 received 4 times. And we know that the sum of the total rent that we have received from the start of the financial year to April, 30 April, is 183,600. So this must sum up to 183,600. Now we've set up an equation that can help us find the original rental income per month. 5,400. All that will give us 183,600. 189,000. And our 18,500. So every month we were receiving 13,500 from this tenant until the 1st of Jan, where we started receiving 12,150. If we go back to our timeline, we can recall that the amount that we want to remove from the rental income is the one that falls outside of our financial year. That is rent received in advance, income received in advance. We can clearly see that we have 2 months that fall outside of our financial year. We have March and we have April. So we need to subtract 2 of the rent that we received after February 2022. And at this time, the rent that we were receiving was not 13,500. It was 12,150 per month. Why is that? Because we are told that on the 1st of Jan, rent was now reduced by 1,350. Total rent that we need to subtract is 2 times 12,150. That will give us a total of 24,300. If we have a look at our answer booklet, there we have it, rent income. This is the amount that we had recorded from our balances. And this is the March, April rental income that we received. The last adjustment that affects the income statement is income tax for the year is calculated at 30% of net profit. The net profit after tax is 356,300 after adjustments. So this is the profit after we have taken out the tax, and what we're looking for is the tax. So what we need to do is understand that the net profit before tax represents 100. Then the tax represents 30%. Then that would mean the net profit after tax. Let me clear here so that we can make some space. To take the net profit after taxes, multiply by what we want 30%. Over what we have 70%. All this will give us an income tax of 152,700 rand. And there is our taxes. Make sure you understand how we arrived at this. The net profit before tax would represent 100. If taxes is 30, then 100 minus 30 remains 70. So net profit after tax represents 70. The last bits of work that we need to do is work out our totals. We have other income and in the business, and you add that to your gross profit to arrive at the gross operating income. So how we got here would be this plus this one. So we're looking at the sum of these two. This should give you this one. We can work out what the net profit before tax is. Net profit, you add tax, you will get the net profit before tax. We are reversing what we would have done to arrive at the net profit. Add back your interest expense. So 509,000 plus 15250 will take you to what you would have had before you got there. Now that we have the profit before interest expense, we are given the operating profit, so we can use these two. The difference between these two would give us the interest income. We're just using the information that we were given to work out the other missing information. There's no adjustment here, just making use of the layout of the income statement as we know it to work out the missing figures, okay? Since we are given the operating profit, we know that how we arrive at the operating profit, we would have taken this amount here, the gross operating income, and subtracted all of our expenses. We don't have a total of our expenses because sundry expenses is our balancing figure. So this is what you're supposed to get. We'll subtract all the expenses that we have in this box. This is all our expenses. And whatever's left off is sundry expenses. This is the end of the statement of comprehensive income. I have linked this paper in the description box. Please have a look at it. In part 2, we will have a look at the equity and liability section of the statement of financial position for 18 marks.